Hello there again. So, we are going to do chapter 6, part 2, the financial budgets. And the piece is a little long, so I am going to get into it right away. Okay, something is not right with my animation, but here we go. I am going to move this pen here. Okay, all right. So, the slide looks very similar to what we had for operating budgets, but this is just to remind you that budgets are used for many different purposes, amongst others, performance evaluation, cost control, etc. Okay, so once again, we repeat our little example. We are running a little bake shop and we have limited funds because small companies have demands on several type of requirements, like they need to purchase inventory, equipment, pay salaries, spend money on marketing. Clearly cash is limited, so they have to spend it carefully. Once again, I remind you that the budgets are linked to each other. In this part, we are going to show you how cash budget is connected to income statement, how income statement is connected to balance sheet. And in the end, there is a very important point here which says that the sequence of financial budgets is kind of important, meaning you need a cash budget before you can make an income statement, and you need an income statement before you can make a balance sheet. Why is that so? This is an important interview question also, plus some food for thought. Why do we need cash budget before we can make income statement? Think about it. Income statement requires revenue, which is not there in cash. It requires cost of goods sold, which is also not there in cash. It requires operating expenses, which are also not there in cash budget. So what do we need cash budget for? We need cash budget for interest expense. This is a number which is not there anywhere else, meaning if the company has to borrow money, that we can see only in the cash budget. And if they borrow money, they will have to pay interest. And interest is allowed as an expense in the income statement. So before we can complete the income statement, we need to figure out if there is a interest paid during the period so that we can put that into the income statement. Now, the second one is kind of easy. Why do we need an income statement before we can make the balance sheet? And that is for net income. Remember, net income is added into your retained earnings account, which is a shareholder's equity portion. So you need to make an income statement before you can make the balance sheet. That is the normal sequence of these budgets. Okay. Let us go into our example data for our ABC Bake Shop. I am giving you sales numbers for December, January, February, and March, which means it can be a pretty elaborate exercise, but you will see the reason in a minute. Now, remember, we are moving from accrual accounting to cash accounting right now. We are trying to figure out that although their sales in a given month are 80,000, 100,000, and so on, how much cash do they collect? Because if the all the sales are happening on credit, then they don't see any cash. So each company has what we call a cash collection pattern. For our bake shop, we are given that their cash collection pattern is that whatever they sell, okay, they collect 60% in the month of sale, and they collect 40% in the month after sale. Okay, we are going to follow this pattern when we calculate our cash collections. We are also given that on January 1st, their cash was $15,000 of beginning balance. Now we are looking into what are the kind of payments this company is making. Typically, the payment that the company makes for raw material purchases is called disbursement. So again, you are given some numbers of how much raw material they have purchased. Remember, you calculated raw material purchased in the operating budget, so it can be linked, but right now I just picked the numbers from there. Now you have a cash payment pattern. Okay. Cash payment pattern is saying we pay our suppliers month after purchase. What does that mean? I pay whatever I buy in March, in April. Whatever I buy in February is paid in March. Whatever I buy in January, I'm allowed to pay in February, a month after purchase. Okay. So we will calculate the cash payment schedule also. You have some other operating expenses of $20,000 a month, which you pay in cash. You have also purchased some equipment in the month of March for $30,000. Okay. The company, just like your raw material and finished production needs, has some kind of a policy that they need to have a minimum cash balance at all times in their cash box equal to $10,000 for emergency and some other needs. So, minimum cash balance is given. Okay, I will refresh your memory with all these things when we need them, but right now, what we have. Okay, so right now, I have taken only one simple question. We are going to keep adding the questions as we go. Right now, we are asking you this question: how much is your cash collection from January to March? Okay, how much cash will you be collecting in January, how much in February, etc., etc. Cash collection is an important question, so I decided to do it for all the 3 months. The question can also ask you for a whole quarter, but let's just do one month after month. Okay, I copied the numbers here so that you can recall what are the sales and what is the cash policy that this company has. Now, let us do the cash collections in January. Okay, remember our collections are 60% of the current month. So it should be pretty clear that we are going to collect 60% of the January sales in January. Okay, what else do you think they will collect? Concentrate on this one. 40% next month, which means December number 60% must have been collected in December, but at the end of December, 40% of December sales were accounts receivable, which will be received in January, right? So, this is the second one that we have to add. From December sales, January collection should include 40% of this 80,000, which means 60% of January and 40% of December. We will follow this pattern for each month. Okay, so total collections 60 plus 32 will give us 92 for January. What do you think would be the cash collection for February and March? You can stop the video and you can try to calculate it before you look at it. But here it is. For February, we'll have 60% of February and 40% of January. So whatever we had not collected in January, we are going to collect in February. So 72 plus 40 will give us 112. Similarly, in the month of March, we will have 60% of March sales and 40% of February, combining them to be 90 plus 48 equal to 138,000 of March collection. Everybody with me? Okay. Let's go to disbursements, as in payments for purchases. Okay, we are going to add operating expenses, etc., to disbursements once we are done with the cash payment patterns. Again, I copied at the bottom what are the purchases they have made in the last 4 months and the payment policy, which is they pay in the month after purchase. So now it is kind of simple. You don't have to break up the number. Okay, cash payments for material purchases. In January, they are going to pay what they bought in December. Correct? And so on. February, they are going to pay what they bought in January. We continue. In March, they are going to pay what they bought in February. Okay. So, in this pattern, we have reached March, which is the end of the quarter. Okay. A possible question can be, what is accounts payable at the end of March? Can you answer a question like that? We'll come to that in a second. So I have copied a whole bunch of data from different sources here. Okay, what you see here at the bottom are the different sales and other information given to you. What I have copied here are the cash collections that I have made on the previous slide, and here are all the cash payments that I am making on the previous slide. Okay, now it is time to put together the whole cash budget. Just to be clear, a cash budget can look like a T account where you can have beginning balance, you can have ending balance, you can have cash that comes in, and you can have cash that goes out. Okay, that is the rough pattern in case your incoming number, for example, for the month of March, your incoming cash is 138,000. Okay, and your outgoing payments are 75,000. Okay, we need to figure out what is our beginning balance of cash for the month of March. We know it for the month of December, but we need to know it for each month. So we will have to figure out if your receipts, okay, are more than all the payments that you are making, then you'll have some ending inventory. Remember, the question is saying minimum should be 10,000. It can be more than 10,000. So we will figure out what our cash budget is going to look like. But these are the three numbers we need to add once we get to the problem. Okay, let us see what we are going to do for January. Remember, we were given our beginning cash balance here at $15,000. Okay, during the month, we did $92,000 of collection. So total cash available is 15 plus 92. Okay, now our payments for January are, this is our payment, and we are making operating expense payment of 20,000. Okay, so ending cash is 37,000, which is much bigger than the minimum that we require. Remember, we require a minimum of 10. So we don't need to borrow. We are all good, and we move to February. Now notice this is my ending balance of January, which will become my beginning balance of February, right? So now in February, my beginning balance is 37,000. My February collections are 112. So total cash available 149. Okay. In February, I pay this plus 20,000 of operating expenses. Okay. So I pay 80 again. I have plenty of cash available. No need to borrow. Okay. This 69,000 again becomes my beginning balance for March. So let's continue for March. Okay. March is 69,000 beginning plus what I collected, right? Then I pay 75,000 and 20,000. And remember, I'm buying an equipment. Equipment purchase of 30,000 also needs to be paid. Okay. So I make all these three payments and I still have ending cash of $82,000 in the month of March. So plenty of cash available because my minimum of 10,000 is met each month. I do not need to worry about borrowing. Okay. But borrowing and interest calculation is interesting. So let us try to tweak the example a little bit. Okay. I just copied the budget that I just made for the month of March so that I can show you a small amount of change into what happens. Suppose the question says my March purchase equipment instead of $30,000 is much bigger, 110,000. Okay. What would my revised March budget look like? Everything else will remain the same. Okay. My cash that came in, cash available plus beginning inventory still remains the same. My cash payments will change. 75,000 will remain the same. 20,000 will remain the same. But this equipment is now going to change to a higher number, which means total amount of payment I have to make is 205,000. Okay. So what is the ending cash? Only 2,000. Now it is important for me to remember that I have to have at least $10,000 in my cash account at all times, which means the cash is too little, which means I need to borrow. Okay. So how much borrowing is needed in this example? 10,000 is what I need 2,000 is what I have. So I borrow 8,000. Okay. If the question tells us that my rate of interest is, for example, 10%, then I would be paying $80 of interest whenever the money is paid back. But we are going to go into those kind of extensions when we do a longer problem in class. I just wanted to show you how cash collections are done, how cash payments are done, and how borrowing is calculated if necessary. Okay. From cash account, we can move to income statement. You all know the format of the income statement, right? So income statement is going to bring together all your operating budgets, your sales revenue, your cost of goods sold, okay, etc., etc. Your operating expenses budget has also been made. So I'm just going to assume that these numbers are there somewhere in the operating budgets. We are just going to try to look at the format of the income statement. So we are going to come back to our accrual accounting revenue. Okay. Sales revenue. Okay. I'm doing it only for the month of March. Remember, I have got data to do it for January and February as well, but I just want to show you a sample statement. So for the month of March, my revenue is 150,000. I have purchases, okay, other operating expenses, and since I don't have any selling general and administrative expenses, I just calculate net income. Sorry, my operating expenses are 20,000. Okay, these are my material purchases. So I can subtract both expenses and I have a net income. Simple enough. Okay. Basic idea is to remember to begin your income statement with revenue, not with the amount of cash that you collected. Why? Income statement is an accrual accounting. It is revenue earned, may or may not be received. But please do not use this number when you start your income statement, because this is the sales revenue earned, not necessarily received. Received or not, as long as you have earned it, it goes into the income statement. That is the main point. Okay. Another point for which students sometimes trip up is to why I did not write equipment expense into my income statement. Remember, equipment is a capital asset. It is not my expense. And therefore, when I make my income statement, I don't write equipment in there. Okay. Sorry, my animation got messed up. So all the data, okay, came in the end, but essentially we really did not need it. I hope you remembered most of the numbers. Okay. Let us go to the balance sheet. I didn't have a whole lot of stuff to put into the balance sheet, but this is a point where accounts receivable and accounts payable become important. So let's just spend a minute on talking about that. There are a lot of numbers coming from previous balances. So let us talk about the cash collections. Remember, our cash collection pattern was 60/40. So 40% of March sales I have not yet collected at the end of the month of March. So this is 150,000. 40% of that is 60,000, which will become my accounts receivable. Okay. Similarly, accounts payable. My policy is I pay month after purchase, which means whatever I bought in March. Oops, sorry. I didn't mean to do that. Whatever I bought in March, I have not yet paid for it. So all the March purchases are my accounts payable. Okay. I already have a cash balance from my cash account. So I can start putting my assets together. Okay. This is the ending balance of my cash for of March. I have it in the cash collection pattern. You can take a look at that. Okay. I purchased some new equipment. So that money is there. My total assets are, let us suppose, 172,000. Now, my only liability, I believe, here is my accounts payable. Then I just pull up some numbers of equity just to make the balance sheet come together. Suppose I was given that my beginning inventory equity, sorry, was 42,000. I need to add my net income of March into that. Okay. So that my balance of retained earnings goes up. Okay. And then my total equity becomes 92,000. Okay. I combine 80,000 of accounts payable and 92,000 of total equity, and I have 172,000, which is exactly equal to my assets. So my assets are equal to liabilities plus owner's equity. Oops, it doesn't want me to write that much in a corner. Owner's equity is what I wanted to write, and I am kind of done. Okay, so longish exercise, but that's all we have for you. Have a great day. Thank you.